Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Michael Hacker, Managing Director, Partner, and Global Head of Portfolio Finance at Carlyle AlpInvest. Mike, great to see you again. How are you doing today? And as always, thank you for your time.
Todd, thanks so much for having me. Really excited to be here and looking forward to the conversation.
So I think a good place to start would be, I know Carlyle AlpInvest has kind of had an evolution the last few years as you've kind of diversified away from just secondaries. And so kind of give us a little bit of a, kind of a level set. Where is the firm today? What does it look like? Where are you focused? I think it's a good place to start as we kind of jump off our conversation.
Great. No, it's perfect. And, in some ways, the firm is actually almost exactly as it was 25 years ago when we first started. We have a fairly large primaries business making fund commitments. We have a co-investment business that's really co-sponsoring deals alongside our GPs. And then what we call secondaries and portfolio finance today is actually, I think, a lot more, and I think this is where your question comes from, a lot more of a solution provider than just a buyer of fund interests. And so, on the one hand, I think what you said is right. We've diversified away from, just the simple act of buying portfolios of private equity funds. But, if you think about what secondaries is, it's really become an equity-oriented solution for LPs and GPs. And then what we've really been on a journey the last few years to build out the credit side of that equation. So what we call portfolio finance is doing the same sorts of things, but on credit-oriented solutions. And so, the journey that we've been on the last few years has been about not just diversifying away from secondaries, but really being able to sort of help our LP and GP partners to go up and down the spectrum, everything from credit to equity. And I think that's been sort of the path that we've been on, and it's really, I think in this market becoming, I think, increasingly important to do something like that.
And within your role, kind of what does your remit cover? I think it was Managing Director, Partner, and Global Head of Portfolio Finance.
Yeah, depending on which day you get me, I've got a few different hats that I can wear. So, and I do have a fairly good impression of an equity guy, certain parts of the week. And then I think my day job is becoming more and more credit oriented. But I think what's actually really interesting about it, if you think about our team, we're about 60 people doing secondaries and portfolio finance today. Obviously some people come from more of a credit background, some people are more equity oriented. But if you think about the remit overall is really to be integrated, right? And I think what we really try to do, even though I think some people want to sort of draw artificial lines between what is secondaries and what is portfolio finance, I think if you look about, our remit is, we're engaging with LPs, we're engaging with GPs, we're listening to the problems that they're having in today's environment, which is, often, either driving liquidity out of the portfolio or providing capital solutions. And so I think my remit, whether I'm putting an equity hat on or a credit hat on, is really listen to their problems, try to sort of figure out what's the best solution for them, not necessarily what's the right product from our toolkit. And that's what I spend most of my time doing these days.
I think that leads perfectly into my next question, which is, how does Carlyle AlpInvest work with GPs to drive, operational value in portfolio companies?
Well, it's a good question. It's really interesting because obviously, if you look at our portfolio, we have a whole range of different GPs, right? So some guys are very growth oriented, some are really value oriented, some people have big M&A follow-on strategies, other people are doing all kinds of different things. And so, there's never one specific playbook that that we say looks better than another, right? And we I think in today's environment, what we're really trying to do is sort of go where our GPs have areas of strength. And so, if I think about, our investment committee meeting this morning, we had, several different proposals in the committee this morning, that ranged from, very value, buying things, relatively, at discount to sort of prevailing multiples, carve outs, things like that. And so we've been big supporters of investments that way. And then also things on the growthier end where we're going to go and consolidate a sector, do a bunch of acquisitions and really sort of pursue something that way. So I think our big objective with GPs is to think about what their strengths are and then support them with capital where we think it makes the most sense. And so if you think about, on the equity side of our house, we're doing a lot of things around continuation funds. So single asset, multi-asset continuation funds, we're somewhat indifferent between the format, but the key there is really identifying assets where the GP really feels high degree of conviction to continue to own that asset, and where we think that additional capital can really support that investment thesis, whatever it might be. And so you see that as a big driver on the equity side, and then obviously in portfolio finance, this can be things like NAV lending, where we're providing capital into funds, often for targeted follow-ons, where there may be a specific capital need, one specific acquisition that they need additional equity to pull off, and we'll provide the capital, in those settings. So it's a lot of it's often the same. It's often the same needs, but we're diagnosing the right way to provide that capital depending on the situation that we see.
Just as a follow-on
Yeah.
to that, is there, kind of a sweet spot as to the type of GP that, you guys are looking to work with?
Yeah.
Is it size, track record? Kind of what are some of the things that go into, all right, this is a GP that we're going to work with?
Yeah. So, I would say broadly speaking, our area of strength and area of focus tends to be in the middle market. However you want to define that. It's a bit size driven. Sometimes the size of company can also be a factor. I think the GP quality is probably the first lens that we always look at, before we make a decision, because it never ceases to amaze me, and especially in this kind of environment, great GPs who are thoughtful about value creation, who are thoughtful about managing liquidity, they do a good job, even if the assets that they're starting with maybe are not perfect. And they'll find the right partner to merge a company into, or the right time to pursue an exit. Whereas a GP that maybe has had a bit of a less success that way, often they may hold that asset for too long. They may pursue the wrong kind of exit. They may look for an IPO to try and squeeze out that last turn of money of EBITDA multiple, but maybe miss the window to actually exit. And so I think GP quality, GP track record is really a lens that probably we look at first before we even start thinking about companies and portfolios. We'll do stuff up and down the size spectrum. So we will go into smaller emerging managers occasionally. We will do stuff with large cap managers occasionally, but I think our real area where we can differentiate and provide value is in that middle market zone.
And how do you think about, evaluating, price risk differently if you're looking at secondaries versus primary commitments?
Yeah, so fortunately, we've got a great team, about 25 people, that all they do are primary commitments, and they're out there meeting with GPs, keeping those relationships of some of our long-standing managers, but also going out and finding the next great group, the group that maybe spun out of somewhere, that will be the big success of the next decade. I think it's actually a harder job than what I have to do. My job is partly GP evaluation, partly asset, to really go and figure out who's going to be successful and who's not, and to make a lot of those assessments. We've got a great team that does that very well. I sort of dabble in that space, from time to time. So I think I'm a proficient amateur in the GP evaluation space, but I think we do a really good job. I think that the hard part is figuring out fundamentally the question you're asking yourself when you're making a primary commitment is, will this group of people who've had this tracker historically be able to deliver those kind of returns going forward? And if you think about the footnote in every investment proposal is always future success, past performance, not a guarantee of future success. And so primaries is fundamentally saying, we understand that, but we're gonna have to go and figure out what were the germs of those success, in the past that we could actually, use to underpin an investment in the future. And so I think that's a tricky proposition. We've done it very well for a long period of time, so we must have a pretty good system for figuring that out.
How do you think about, what strategies you're using to manage liquidity in, say, a less predictable exit environment that we're in today?
Yeah, this is the hardest thing. I think, you've got a lot of issues going on in today's market, and what solution is often sort of a tricky question, right? So, if you go back a few years ago, you had multiple good options for liquidity, right? Strategic buyers were flush with cash. Sponsors were able to acquire businesses. You know, Now you still have good exit routes. The problem is that where you want to sell is not necessarily where those buyers want to buy, and I think this is the challenge that I think GPs are facing, which is you know what's the right path for me to do I continue to hold an asset? Do I take liquidity early? Do I use some of these tools like a continuation fund in order to drive an earlier exit or a liquidity event for my LPs while still holding the asset? I think this is actually it's a very case by case kind of determination. So, what I will say is that secondaries or portfolio finance, right? And we can talk about NAV lending in particular. These are not panaceas, right? These are not things that you can
Yeah.
go into a portfolio that's not performing and suddenly create liquidity for a portfolio where otherwise you couldn't, right? And I think the secondary market has figured out for those of us, some of us figured this out very early, and others have figured this out more recently, that if other people are not buying an asset, maybe that's a sign you probably also shouldn't be buying that asset. And so, I think the secondaries market, portfolio finance market, these are tools that you can use often to put capital into companies in terms of
Mhm.
driving real exits for companies that otherwise are not exitable. I don't know that this is necessarily the solution. I think a lot of what we're doing with GPs is actually helping them to think through, hey, figure out and triage what in your portfolio should you be focused on liquidity in, and what are the assets you should continue to focus on value creation, and to understand the difference between the two. I think that's the hard part. Better GPs understand it intuitively or seek out the help to figure that out. And I think the other GPs are starting to try and figure out if they can improve their processes to do that. And one last thing before Kenley, one of the really interesting things, you were asking about GP quality earlier. What's really interesting in this environment, one of the things that I've actually in a bunch of conversations, you have some GPs who never really had any formulated way of thinking about exits and liquidity until we hit 2022, 2023, which is actually a little bit, it's sort of mind-boggling. It just happened so naturally that they never really thought about it systematically. And I think most GPs are now, really putting real resources, senior resources within the firm to think about those topics, where historically that might have been delegated down to the investment teams. Better GPs, I think, have always really made that a part of their process, and you'll see more and more, I think, focus on that topic coming out of this cycle, which is, only could be a positive, I think, for a lot of GPs.
As a follow-on to that, I mean, it feels like also, I think what we call fund finance, I think what you guys call portfolio finance has really jumped out the last couple of years. It feels like it's on like this, supercharged trajectory now
Yeah.
where it's just taken off. And it seems like that's kind of correlated around the same time period that you had mentioned. And is it in part due to this, kind of volatile exit period, and that other tools have had to been created in
Yeah.
bigger ways for GPs?
Yeah, it's a great question. So it reminds me a little bit, I've been doing this for a while. It reminds me of how the GFC, the global financial crisis in the 0809 period, really sort of sharpened people's focus on secondaries. So going into the GFC, you'd go and have a conversation about secondaries, and people barely knew what it was.
Hmm.
Maybe it was sort of this niche thing. They weren't really thinking about it. Coming out of the GFC, everyone had a view on it, whether they had used it yet or not. And I think that was a watershed moment, the development of that market. Was it all driven by the GFC? No, but it was a sort of a step change in the market's development. I think in the same way, whatever we want to call this period of time that we've been in since 21, 22, is going to have a similar effect on portfolio finance. And we can talk about the distinctions between fund finance and other things that we're doing. But I think when you look at where we'll be in the next few years versus where we were in 2019, 2020, the market's going to be exponentially larger. And I do think that there's a lot of this growth is going to be here to stay. And so, I don't think this is just a very cyclical thing that's going to go back and revert back to a small market, because it is actually quite valuable. But it was really important to have a moment like this to just build awareness, understanding of the tool. And now that people really understand it, it fits into this larger toolkit, just like subscription lines, did last decade. Things like NAV lending, for GPs, the LP interest financing for LPs. These are tools that I don't see going away, once people are aware of what they can do.
So related to the co-investment strategy, how has the firm's co-investment strategy evolved, and kind of what's driving some of those changes?
Yeah, so that's a great question. So, if you think and you go back to when I first joined the firm, in 2007, a lot of what we're doing in our more sizable co-investments, if you think about to that point in time, there are a lot of these large buyout club deals that were really occurring. And so a lot of what we did, in that period of time was really participating alongside, a couple of our different sponsors there to help them get these large buyout transactions done. If you go after the GFC period, I think a lot of what we were doing, especially as we started to shift our focus really towards the middle market, was really to co-sponsor transactions alongside the GPs. So, often what would happen is we would come in early into the process and work alongside the GPs, sort of in what I call deal speed. So, right, there's LP speed, which is a little bit slower, and there's deal speed. And so a lot of what we were doing was really helping the GP while they were in the process of doing their diligence on the asset. What we would what we'd look to come into was a situation where the GP said, "Hey, this is an asset we've either been tracking or it really fits our sweet spot in our investment thesis. We want to go after this in size, but the size of the equity check is going to be too large for us to speak from our fund entirely." And so, often in those situations, we'll come in a very similar size to what the GP may be underwriting for their own fund, and try to participate alongside them in the diligence alongside them. I'd say that's the vast majority of what we're doing these days, these co-sponsored, co-underwritten transactions. We'll of course do syndicated co-investments in a variety of different situations, but that's where we really can add value to our GPs. And if you think about the context of what I was talking about earlier in terms of providing solutions, a lot of what's happening these days is a GP will call us and they'll say, "Hey, I've got a capital need, I've got a company, a situation, something I'm interested in doing, and I may not even know, is this a co-investment opportunity? Is it something for our secondaries platform?" But we have such strong relationships with these GPs. They'll reach out, they'll talk to us, we'll listen to what they're trying to accomplish, and we'll figure out the right kind of capital for them to get their transaction done.
Is there anything specific that makes a characteristic that would make a GP stand out to say, all right, we're going to go down a co-investment opportunity here? Or is it more just like you said, they'll come in, they'll listen, and you kind of see what tool in the toolkit really fits them best?
Well, I think, so obviously the capital, the need for capital being too large for what they can accomplish. But, I think what's interesting is you sometimes see the Venn diagram, there are some overlapping portions of it, right? So sometimes a GP is thinking about, "Hey, I want to take an asset that's in an existing fund, and I was originally thinking I might do something where I'm going to sell that from my old fund to my new fund," right? And a lot of what we're going to think through with them is going to be, is that actually a continuation fund opportunity? Is it a fund-to-fund type transaction? Does that create, co-investment? Are they looking for effectively a minority recap of an existing asset where they're taking liquidity out? Can we provide solution there? So, I think we have a variety of different tools, but, Todd, I think the honest answer is that those circles come together, often, and we have to think about what's the right kind of capital. How do we create alignment with the GP, to actually invest in that, in that transaction? And again, those tools and they're a bit facts and circumstances based. And so, we do a lot of listening. I know that's sort of a little bit cheesy to say it that way, but often we're listening to what the GP is saying. We may have an inclination of what might be the best deal for us, as where we want to put it. But often I think what we're really doing is trying to figure out what's the right solution for the GP.
So going back to, secondaries, in today's market, where are some of the most compelling opportunities for secondaries?
It's a bit crazy to say, but I feel like the market's been hitting on all the cylinders. So if you think about, where we've been spending time, we're active in both LP transactions and in GP center transactions. So if you think about, let's take the LP side for example, you're seeing probably one of the largest opportunities. This, if you go back in time from an LP perspective to 2021, and you think about that was probably the most cash distributive year in the history of private equity. And yet in that year, LPs still put more money out and committed additional capital into private equity. And so we were net negative cash into our investments in 2021. And obviously the music stopped a bit, starting in 2022. So, we've had to rebalance, hundreds of billions of dollars of private equity exposure that's really been an overhang to the market. So, if you think about it, that we're solving that issue on the GP side. I'll come back to that in a second. But on the LP side directly, this is not a denominator effect issue. This is fundamentally, managing exposure and trying to rebalance portfolios so that people can get back to investing in new commitments. And I think if you look at it, if you don't rebalance your portfolio, often that's going to mean other consequences on your investment activity. You probably have been shutting down new investments for a couple of years already, and that may persist, which is going to mean that even though on the one hand you didn't sell and you didn't take whatever discount in the last couple of years, it probably has some go forward impact on what your portfolio buildup will look like, what your returns will look like in say the next couple of years. And so I think a lot of what's going on right now is LPs reckoning with that that set of choices. And so you're seeing just this large flow of LP activity. We've been doing a lot of interesting transactions. A lot of what we're doing is bespoke. I talked a lot about listening on the GP side, but on the LP side, this is also part of our toolkit where we had a really interesting conversation that hopefully will turn into a transaction just recently. And we're actually with that LP talking about both a secondary solution and a recap solution, right? Effectively a leverage recap of their portfolio. We may do both. We may do one. We may do the other. But I think a lot of what we're seeing now on the LP side is again this reckoning with those choices and using these tools much more actively. So I think that part of the market, it's been very documented. There's been a lot of focus on endowment selling. That's obviously that's a very small piece of the overall puzzle. This is just a much larger issue that ripples through. And on the GP side, it's the same fundamental issue, which is that a lot of capital was invested. GPs are under a ton of pressure from their LPs to generate liquidity. I mean, pretty much every conversation that GPs are having now has some overhang of, hey, what are you doing to get me my money back? And so, I think GPs have learned, like, if they're going to go back out and raise their next fund, they better send some distributions, some meaningful distributions back to the LPs. And so this is where, if you go back to what I was saying earlier about continuation funds, whether it's single asset or multi-asset, kind of let's hold that to the side. But fundamentally, it's solving this tension between, on the one hand, my LPs desperately want liquidity back from me. And on the other hand, I have assets that I can't go out into the market today and recreate those platforms. And so how do I solve that tension? Often a continuation fund can be a really good solution, which is I'm actually holding my asset while generating liquidity for my investors. And I think that's been something that, whereas a few years ago, LPs were trying to wrap their heads around whether they liked this or didn't like it. I think today, most LPs understand this is actually an important, part of the market and where it's going. I think there's been stats out there. It's probably something like 13 to 15% of exit activity last year. That's a meaningful percentage of the market. And so, you're going to see that growth, I think, continue. And I think the GPs really like the structure. And so, we're trying to figure out right ways to make sure that, we don't make it too favorable for the for the GPs, because we want the alignment to be good. But this is something that I think is here to stay. So, what does that mean next few years? It just means that there's a lot of supply in the market. And, I think for the buyers like ourselves and our competitors, the challenge has actually been creating enough capital to go out after these opportunities, because the opportunity set is just so big. So there's a lot of attention focused on capital formation, fundraising, but the honest truth is actually there's probably not enough capital in the market to go after all the opportunities that are there. So that'll be an interesting one to figure out as we get 2027, 2028, and beyond, and what does that look like?
What about distressed or special situation opportunities?
Yeah, I will say that the market's probably moved a little bit away from more challenged situations. in part because, you can generate really attractive, returns, just pursuing regular way type, investments without having to take a lot of distressed risk. And so,
Hmm.
I think, if I were to go and think about, who's really focused on distressed situations, I think there are some people who will do that, in the market. I don't know that necessarily, you're compensated well for the additional risk that you're taking. And so if I think about, our choices, we probably have stayed closer to better performing assets, better performing GPs. That's been a conscious choice of ours. I do think there are interesting opportunities where you can provide additional capital, to help support a business. I think we've
Hmm.
actually been using our NAV lending, our portfolio finance toolkit there a bit more, where if a GP really has a high degree of conviction around an asset, we'll provide them capital at the fund level, allow them to inject that capital into the company, continue to sort of support that business, and hopefully, recover value for LPs there. I think that has been probably our preference as opposed to us just providing capital into that company, taking on the additional risk. I think, we've so far stayed away from those kind of situations.
Stepping back a little bit, when thinking about, we've had a pretty volatile year this year from a macroeconomic sense.
Yes.
How do those factors, tariffs, interest rate, inflation, kind of impact underwriting?
Yeah, no, it's actually, it's funny. So when and I hate calling it Liberation Day, but the when when
Everyone
that
says that, by the way. It's like, I hate
it's
calling it
it's
Liberation Day.
it's such a terrible name, but since everyone understands it, I'll sort of, we'll go back and talk about that. But it was funny. We actually had our annual meeting over in Amsterdam that week, and so it's forever ingrained because we were with all of our LPs asking us to share our wisdom and insight about how the market was going to play out. I think we tried to just keep everyone calm, sort of during that period. It was interesting because, like every other turbulent market environment, secondary buyers are no different than anybody else. So, they can get scared, they can get spooked, they can say, "Hey, listen, I'm going to be risk off." And you saw that for a little bit this spring, where there were some situations where all of a sudden, we found that some of the buyers were holding back a little bit risk off. It was interesting. We were actually able to step into one situation and get a transaction done by just not doing that. And so, that was a little bit of trying to zig while everyone else was zagging. But, I think the market, though, pretty quickly realized that, we would probably get through that. And so you start to see, buyers start to come back in the market relatively quickly thereafter. So, I think the actual sort of spasm that we had this spring was definitely, we were not immune from that. There was some concern at the moment that it would actually derail volume because buyers would hold back and wait for sort of the next couple of quarters to see how things played out. I think the truth is the buyers, like the public markets, came back relatively quickly. It's funny. It's never an easy time. People always ask me this, and they say, "Well, is now an easy time or a hard time to invest?" And I think, to me, it's when everyone thinks it's an easy time is actually when it's probably the hardest time, and vice versa. And so you just have to sort of stay focused on the fundamentals, on value, try to figure out what's worked for you, buying good quality companies, staying sort of rational on valuation. That's probably the hardest. I actually find it much harder in buoyant environments to invest because, everyone's so risk on. I think we've actually been threading the needle pretty well. Public markets have gotten a little bit, exuberant, but our market has actually stayed reasonably rational. And so, we haven't been sort of pushed to go to extremes on valuation yet. So I think that's a little bit the story of this year. I think the market's getting a lot done in terms of volume. I don't know if that's ever the right measure of how attractive a market is or isn't, but we are seeing a lot of activity actually happening, and supply and demand are meeting at sort of an interesting place from a pricing perspective as well. So, we'll see how long that lasts. If public markets continue, to tear, that has its own consequences. And it's never far from the back of my mind that there will be more disruptions, and this is kind of an interesting and challenging environment to be investing in. Stuff that we haven't necessarily seen before, in PE in a while.
Looking out a little bit, is there any particular sectors or geographies that kind of, are looking like they're maybe the next big thing or ready to outperform in the next
Yeah.
few years, given your global footprint?
It was interesting. So we were underweight Europe for a while, and we were able to get a bit more done in Europe recently, and now all of a sudden, it's interesting. Right after we did a lot of that, all of a sudden people were talking about how Europe, there's going to be more defense spending, and the macroeconomic value of that. I don't know if we front ran that just a tiny bit or not, but I think it's been a tough market for quite a few years, and so if anything, a normalization in Europe would actually be interesting for us. We've got a lot of folks on our investment team over there, and so we're always looking for opportunities, over there. Asia, it's interesting, from a geographic perspective, has been a bit challenging, especially on the GP side. For a while, it's a market that, is always very much, you know, uh, in our minds, in terms of, we want to find places to invest there. But when you start thinking about what we talk about Asia, you really sort of distill it down into a bunch of small micro markets, and you start thinking about, what's really interesting. Where can we buy companies, and then have a very clear path to liquidity,
Hmm.
and you start to very quickly disqualify certain of the markets. And I won't insult anybody by naming those, but you can sort of get a feel for where those are. And so, I think Asia to me has been, an area where we'd like to be a little bit more front-footed, but haven't. Sector-wise, I think we've been a bit, and none of this is going to be, defying, or set, blazing new trails. But we've stayed away from a lot of heavy industrial stuff with very complex value chains and supply chains. And in part because I think, again, going back to complexity and what we're getting paid to invest behind, we found a lot of those over time. There would be more challenges that would pop up unexpectedly in our hold period. And so over time, we started to migrate towards more predictable services businesses. And I don't think that's anything that is blazing new ground. But I think for us, that was really our focus. Now, the question is, if that's such a conventional wisdom, way of thinking, are there areas? And we did do something earlier this year that was a bit more industrial, in part because we felt like we were being compensated very well for doing that. So occasionally we'll do things like that. I don't think that we're looking to sort of shift sectors, geographies, too much, but we think about relative value in that way. And if we can overweight some areas that we feel like are underappreciated, there's definitely some willingness to do some of that.
What about structuring and some of the innovation happening there? I mean, I know you
Yeah,
guys have done some large CFOs. I see securitization technology coming into the fund finance, portfolios finance space a lot more. Where
yeah.
are some of the interesting things happening there? And then, kind of a secondary piece to that, is there a regulatory risk on structuring that might pop up in the next few years?
Yeah, so this is probably a much more interesting question for me, and I don't know how much time we have for this podcast, but I'll try to be somewhat concise. But yeah, what we've been seeing when it comes to structuring solutions, I think is probably the most interesting piece of this. And again, going back to the journey that we've been on for a number of years, is bringing structuring, to these transactions. If you go back and you think about what portfolio finance was circa 2018, 2019, it was very sort of simple, unitranche kind of loans that people were making to the borrowers. Today, if I think about, transactions that we've done recently, we've done quite a bit of structuring behind the scenes, right? And so, you think about loans that may look very conventional to the borrower, where there's a single maturity date and a single coupon. Behind the scenes, we're going to bring different pools of capital that are seeking different places in the risk return curve. So you might, for example, in the same loan structure, be able to bring some investors who want to own whole loan exposure there. And we may rate these, by the way. So we now have clients that are interested in rated exposure. So we might rate a transaction and bring in an investor who really likes whole loan exposure. We have other investors who may want a super senior version of that structure, and other investors who are looking for something that's a bit more yieldy. And so in the same transaction, we may be able to solve all those problems for our different investors and get them exactly what they're looking for. And so that's been something that we've been doing now for a number of years, going back to 2022. We've just gotten a lot better at it, over the past few years. When it comes to rating agencies, regulatory, there was a lot that was talked about a couple of years ago with the NAIC, and this may be a little bit too in the weeds for everyone on this podcast, but the NAIC I think was doing something that was quite correct, which was there had been a few securitizations that were really all about regulatory arbitrage or ratings arbitrage, if you want to think about it, where you would take a pool of assets, you would tranche it up, and then all of a sudden you'd be left with sort of something that was much more favorable from a ratings perspective. The sum of the parts was or the individual parts was much more favorable. And I think the NAIC came in there and was asking a lot of really good questions. And so what it's really done is it's forced the issuers of CFOs, right? And by the way I think about our portfolio finance capability, where we're lending, and our CFO technology, where we've actually been issuing our own collateralized fund obligations, they're just two sides of the same coin. We're bringing that technology and the ratings technology together. But if you think about that, it's put a lot of emphasis on product design. What's the underlying collateral? What's the reason for the transaction? And so if you're just going to try and throw a few things together and try and get it rated, I think you're getting a lot of pushback from the rating agencies, from the investors, from the regulators, and rightfully so. And so if you look at the couple of transactions that we've done, one last fall, one very recently that we just announced in the public, I think both of those, we spent a lot of time matching together assets, different places in the vintage curve, different kinds of assets, highly diversified portfolios, in order to achieve something that we thought was actually checking all the correct boxes from a regulatory perspective. And you also have to manage how much leverage you're adding into these. I'm certainly not. I lived through 2008. I've seen the movie The Big Short. I read the book. So we're aware of all those kind of very standard critiques. I don't think we're looking to recreate those issues. I think what's really interesting about private equity as an asset class, it's very uncorrelated with each other. And so when you think about if we're doing stuff at moderate loan to values, I think it could be something that is actually both very defensive for the note issuers, very interesting for the equity investors in those structures. And so that's a bit of what we're trying to accomplish there. But a lot more to come. I think we've done a couple of these now. We're not looking to build a business around it, but it is something that we think it can actually help us deliver better solutions for the end borrowers or the end investors. And so that's a lot of what we're trying to think through.
Final question before we jump to our fun questions and wrap up. What lessons from past cycles are you think most relevant to navigating this current market environment?
Yeah, what's interesting, and I was a history major in college, and I was talking about that recently, and it's funny because this cycle, every cycle is a bit different. If it was exactly the same as the previous one, we wouldn't have these kind of cycles. I think what's interesting about this one is it's actually been quite a bit different than what people thought it would be. And so, I think in the past you thought, okay, we're just going to have a general macro slowdown. You might have a big market gyration. We've now had several market gyrations that have occurred since 2022, and I actually think of this as really one big cycle that we've been in, the last 3 or 4 years. I think what's been challenging, obviously, is you've had, persistent higher rates, which has sort of upended a lot of the rule of thumb, lessons that I think people, sort of had about what works and what doesn't work in buyouts in the 2010s. And so people had to go back to the drawing board and figure out again, what kind of businesses, what kind of valuations make sense, how much leverage should I put into these companies. So, I think this cycle, it feels like it's happening slower and more drawn out than previous ones where you had a bit of a V. This has been sort of a big, deep U. And it's even hard to say that we're in a negative part of the cycle, because you look at public markets have come back, but private equity, I think, has not necessarily recovered, and we'll have some time where these vintages, these 2020, 2021, vintage investments, which are a huge part of people's portfolios, it's gonna take a lot of time to triage that. So, I think what's been good about this cycle is it woke people up to some fundamentals that I think they had forgotten about, in the 2010s. It definitely makes you, if you didn't know what interest coverage was before 2022, you do now. I used to joke that our associates, we had a whole generation of associates that never had to learn interest coverage or fixed charge coverage. And so a lot of what we're doing now is going back to things that, people knew, 20 years ago, and some things work and some things don't, and how we triage the stuff that hasn't worked. That's going to be the challenge of maybe not this year, but a couple of years from now, and how do you resolve those portfolios that have gotten quite old? What happens with those? That's going to be something that we're spending a lot of time thinking about now, and we'll see where we get to in sort of the latter part of this decade. So I don't know, still more to come. I don't know if that was a definitive enough answer, but it's certainly what I love about it is that each one of these cycles, it reminds me of stuff that I remember from when I was an analyst, more so than stuff that we saw during the GFC.
Now on to our fun questions.
Love it.
As we get close to
Those were all fun, so I was enjoying them
well,
already.
it sounds like it based on your responses and certainly your enthusiasm, for the topics. Do you have a favorite sports team and or hobby?
So I'm we were talking about, I'm from Long Island originally, and it sort of defies conventional wisdom, but I am a Yankees Jets combo, which is a long story. I combine the most storied franchise in history with the least storied.
There you
Uh,
go.
and I am a Knicks fan, so long suffering. Two-thirds of my fandom are very long suffering, and maybe the Yankees. Well, I think they're languishing in third place right now. Maybe they'll have a late season push. So those are just, I'm not a college sports person. Growing up around New York, there weren't really the colleges of
Yeah.
sports. So all pro teams.
One book that you'd recommend reading?
Ah, so well, I will admit that this summer has been the summer of the Reacher books. So I've actually I've gotten off of my normal nonfiction to go and read all the Lee Child, Jack Reacher books. I wouldn't necessarily recommend that, but I was actually going back recently and going back and rereading the John Brooks Once in Golconda and the Go-Go Years, which are sort of both about periods of time that were a bit exuberant. So Once in Golconda, which is sort of the Great Depression, and the Go-Go Years, sort of at the end of the '60s. But if you haven't come across John Brooks, his books were quite good and formative for me. So maybe that's two books, but I'll stick with those.
One surprising thing about yourself?
Well, I hit the history major. People that I meet, usually think of me as sort of a like a technical finance guy. That sort of maybe it's the the Wharton thing, but they will I think on further reflection see maybe there's a little bit more I can talk about. So lots of interesting sort of historical tidbits. So that's usually where I tend to go with the.
Were you
Uh,
hoping to be a professor or something
you know,
early on, and then you found economics or finance after undergrad? Like what
I
was the
was
history?
it was funny. I was working in Washington D.C. I worked in the Senate. I worked on a presidential campaign. I had this image that I was going to be somehow in the political government sphere. And for a variety of reasons, I became a bit disillusioned with that, which was probably
Who
probably,
hasn't?
probably yeah. I was a little bit of an early mover on that, I guess. So I managed to get off of that merry-go-round before it really did any real lasting damage. And then somehow I did come across investment banking. I had been reading, you were asking about books. I had been reading some books like Predator's Ball and Den of Thieves and Barbarians of the Gate, all the classic
Yeah.
1980s buyout stuff, and had the opportunity to get into the leverage finance world, high yield leverage loans, that sort of thing, and never looked back. So it was a bit of a couple people taking a risk on me because I didn't know the first thing about finance when I got into it, and me trying something completely new. So, and that's been a good match.
Most exciting part of your job?
I love the sort of innovation aspect. I think, what's been fun, if I think about, I've been doing secondaries and now portfolio finance for about 20 years. and it's been ever changing. What's really cool about it is we can throw things on a whiteboard, try to figure out something that's never really been done before. And obviously, we're not innovating from whole cloth, but we are bringing stuff from other markets that maybe have never been tried in private markets before, and seeing if it works. And I always say sometimes you just do a really interesting deal, but sometimes you come up with something that becomes the framework for an entirely new market. And you think about things like continuation funds, where we were really at the early parts of that and trying to set the rules of the road for what that market's become. We were literally on a whiteboard trying to figure it out. And today that's a huge market. Same thing for parts of portfolio finance. We started doing that just a few years ago when it was a tiny little niche cottage industry. It's on its way to becoming a real scaled market. And so that's the cool part of what we get to do is constantly inventing, changing, which is good for me, because I don't know if I have I've got a short attention span, so I need to come up with the next interesting thing. So yeah.
And final question, one prediction for the next 12 months.
I think my main prediction is, especially with what we've got going on, on the government side, is that it's going to be predictably unpredictable. I think there's a lot that people are not factoring in on the geopolitical side that I think is pretty sizable in its potential ramifications. We've got a U.S. government that's trying new things that, whether you like them or not, they're quite different. And I think these changes in trade policy, enacting tariffs, the implications of that, I don't think we really know, or we haven't really tested those. And so what's the effect going to be, second order effects on companies that we're spending a lot of time thinking that through, but I don't know that we know. So I think that, to me, is we know that there's those factors out there. I don't think we know what the implications will be. And so I'm sort of trying to keep everyone's head on a swivel on our side, and making sure that we're looking and thinking and trying to avoid the big obvious red flags. So I don't know if that's a prediction, but it's interesting times to try to invest in, and we're trying to do the best we can in this environment.
Well, Mike, I really appreciate you spending some time with me today. So thank you. It's nice to see you again, and obviously continued success to you and the team at the firm.
Great, Todd. Thanks so much. Really appreciate the conversation.
Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.